In today's episode, we talk about what growth really looks like for a real estate entrepreneur and their business.
I need $1 million. Can you give $1 million? Justin and I had $1 million in the pipeline loaded up, set to close that week. Friday'd be cool. I'd take anything before Friday, but Friday's my deadline. But luckily, we didn't miss any of those closings. We found all the money.
It's not a straight path. There are twists and turns. So let's get into one person's story. Hello, guys, and welcome to another episode of The Freedom Blueprint. I'm Adrienne Green, and today I have with me Matt Medrano. We're going to talk about how real estate entrepreneurs can escape the grind and create the life of freedom that they got into real estate for in the first place. So, Matt, thank you so much for joining me.
Thanks for having me on.
To ground us, can you start with a quick snapshot of what you focus on today at Dynamo Capital?
One of our founders, my partner and I founded this in 2023. Our roles have dramatically changed from really running the entire deal from soup to nuts and, learning how to be a lender. But we were brokers prior to this, so we learned how to be a lender all at once. We didn't have a fully grip of what all that meant. We just established another line of credit for our lending facilities. And so a very big deal for us to continue to grow. Funny enough, none of the things that we're doing today at Dynamo even existed to us mentally when we started Dynamo. At scale, private lending is a lot of Wall Street kind of techniques and friendships and connections and partnerships and, networking and whatnot. Here in Kansas, we had none of that. We had no access to any of that. We didn't have any of that context. In fact, the first context that we had of the broader private lending industry was about 6 months into our starting Dynamo. And we went to our first private lending conference in Newport. The first I was in California, a lot of firsts for me, but the first time we've been in a industry level setting, which was pretty jarring for us. And kind of the first time that we realized we had something meaningful in Dynamo. Yeah, none of the techniques that we use today, whether it's, any flow trading or forward commitments or lines of credit or purchase to partnerships or any of those things, did we even know really existed or the why behind them. At that point, we were always used to brokering loans to the Chiavis, the Lima ones, the lending ones of the world. And we had no idea how the sausage was made or that we could be our own sausage makers. And so, we decided to become butchers and figured it out on our own. And we did things, what I would consider kind of the backwards long way, all the way through to how we got to being where we're at today. The traditional path, generally speaking, in private lending is you start with a, some kind of flow commitment that requires minimal capital from the lender themselves. And then you graduate into having, a balance sheet and you're a discretionary lender. We took the complete opposite route. We started out with a balance sheet, started raising a fund, and then realized there were forward flow commitments and trade partnerships that you could have that could increase liquidity. So it's been we kind of did it the hard way and then are easing into a more sustainable, less gray hair inducing, style of business. But I'm glad we took the way we did because it's pretty unique to us, I would say, especially as we've gotten more entrenched into the industry and kind of learning who the players are and how it all works and kind of the guts behind the machine. But yeah, it's a very interesting thing. My day-to-day, I guess to go back to the original question, my day-to-day is kind of a little bit of everything. My main component of the business that I'm most interested in is the sales side of things. I'm hard pressed to do what we say. What we do is sales. It doesn't really feel like sales to me because I think sales has a negative connotation in the general sense. What we really do is we are the capital partner for all of our clients. Active silent partners, if you will, with our borrowers in the fact that we show up with the money. They don't have to fill their capital stacks and that we help them underwrite and make sure that deals are viable and that we sign off on a deal. But at that point, we fund the project and it's in the borrower's hands to get the project done and then help us both exit safely. To be clear, we don't take any equity or anything in the projects. We are purely on the debt side and good success so far. We've been running since we started in the tail end of 23, didn't start taking our first real capital until Q2 of 2024. And so we're coming up right on really what I would consider our 2-year and not count the beta test we did to begin with. We've done right around $150 million in loans, carry a book of about $100 million in loans today. And it's north of 150 million. But yeah, it's kind of all running together at this point. But it's numbers that we would have never expected or anticipated. And here we are.
Right. And you've done that while really niching, right? Can you talk about the specific clients and market that you serve?
Yeah, so we're in Wichita, Kansas, which, unless you follow college basketball, you've rode in a plane, or you're familiar with Koch Industries, Wichita's the air capital of the world. And pretty much every plane that's come through Wichita has come through Wichita. And, Koch Industries is like probably the biggest name logo here in Wichita, but otherwise, most people haven't heard of it. South Central Kansas, generally speaking, the private lending market is dramatically underserved in the Midwest. And so we were kind of first to market in a big scale here. It's dominated by local mom and pop shops and local banks and credit unions, right? Local banks and credit unions generally don't want this type of lending action anymore. And they've really tightened the purse strings and closed the vault in a lot of ways, especially post COVID or following the immediate aftermath following COVID. And then generally speaking, like, big time private lending is mostly on the coasts, right? The Californias, the Floridas, the coasts are dominant, and they don't need action in the Midwest because there's so much demand on the coasts. And the Midwest generally wants to work with a Midwesterner. Like when we were brokering loans, for example, all the account executives that were responsible for our account and taking loans from us, very rarely do they even have a central time zone. We're in the same central time zone as us. So, if we were lucky, we had somebody in Texas, which is its own country. It might as well be. It doesn't really count. In the Midwest, in my opinion, there's never been anybody that covered us from Iowa or Nebraska or anything like that. Maybe we had somebody
Yeah.
located in Denver that would take care of us, but that's mountain. You get the point. It's just
Mhm.
really underserved out here. So, one, the loan product that we offer at 100% loan to cost lending is very attractive. People want their project fully funded. But then
Yeah.
also being one of the only ones that does it here in the Midwest meaningfully, right? I mean, there are some lenders that have access to the Kansas markets. They have some clients out here, but nothing too crazy. And they're generally speaking located in Kansas City if they have it. So here in Wichita, we have a really interesting real estate market, very stable, knock on wood. Housing prices in a market. We have a lot of investor style clients because of the large corporations that are here. Well, there's a lot of liquidity here. And then there's also those large corporations employ a lot of people that are workforce style housing needed. And so there's a good, strong rental market as well. So it's a really hot spot for consistent flipping and consistent property ownership. I mean, the 1% rule still loosely applies, which I think is a rarity in today's day and age, given where taxes and insurance and everything like that's going. So, yeah, no, I mean, it's an interesting market. It's underserved. We happen to be the ones that raise our hand that we step in and do it. One of the main things that separates us is, we've taken a mom and pop shop approach using Wall Street-ish techniques, right? So access to larger scale capital. We're trying to do mom and pop shop lending at scale, which is kind of an
Right.
oxymoron, but, to apply some of the liquidity tools that we know are out there based on what we've understood about the market, but then also still like operating at a local mom and pop shop focused feel. When we add a loan officer, generally speaking in the Midwest, we're converting a former flipper, a wholesaler, a this or that into a lender, into a loan officer,
Okay.
because there's not really established loan officers with established books out there.
Mhm.
That just doesn't really exist. And so we want to have a very local feel to all of our LOs and that we operate in the areas that we're in. So we have a couple hotspots. Wichita's one. And we also have a good contingent of investors in Colorado, specifically Denver in the Front Range area. So naturally, we have a lot of deals out there as well. We like the Front Range area, and it's performed well for us. So yeah, I mean, we want to feel very local, but also sustainably large, that we kiss of death as the lender doesn't have enough money to do something, or, has to turn away deals. And as an originator, turning away deals is not what I want to do. I want to do good deals at scale and at volume. And so you need some liquidity tools, because pure balance sheet lending is very difficult to raise
Mhm.
every dollar, which is what we used to do. And so now we've gotten a lot more efficient with our capital usage, and it's allowed us to stretch, a dollar of our investors' investment to reach more borrowers and more flippers and fixers.
And I'd love to talk more about what you do on the liquidity side. And you also said something else that I think for anybody who's in the lending space who is listening, you mentioned the 100% loan to cost. That is very rare. And what people immediately like, the traditional response would be, how do you mitigate the risk of that? Right.
Right.
So talk to me about what that looks like on your end.
Look, we're very contrarian in pretty much everything that we do, right? There's no shortage of that philosophy in how we price loans and how we size loans. When we were brokering, we're always asked for higher leverage. If you're brokering, you're used to the 90, 92 and a half LTC, maybe it was 95. And the question, no matter how high I get the leverage for somebody, was always, hey, can I get to like the last 7.5% of that? Or can we get to the five? Can we get to 100? Always. And the immediate question is like, well, let me see what's out there. Not much out there. There's a few that do it. There's usually higher rate, higher fee, and you have to you pay for it. And the client never batted an eye at those things
Right.
because the capital stack certainty was much more important though. Yeah, I mean, and otherwise it's always a race to the bottom. The 90 LTC, the 85 LTC, it's, who's got the lowest fee, who's got the lowest rate, all that stuff. And that's what you're competing over. And I think generally speaking, that business is kind of messy. If we just go to the opposite end of the pool, to the 100% loan to cost lane, there's not many people out here. It's what our market is asking for too. We're here to meet that. From a risk perspective, our book performs better than industry standards. And by example, we foreclosed on 2 properties, of which were for the same borrower. And we've done
Mhm.
plenty of loans that should have statistically been foreclosed on, right? Like that we should have had more foreclosures than we do today. It's really
Mhm.
a testament to our underwriting process. We're very good at projecting the ARVs, again, knock on wood, and making sure that we're not getting borrowers stuck in bad deals. And we really do become an extension of their underwriting team. We are their underwriting team for our borrowers, helping
Right.
make sure that they're safe and sound. I mean, and a lot of times our borrowers are more conservative than us and what fits in their buy box because we do 100 LTC, 75 LTV. Our borrowers are looking for somewhere in the 65 to 70 range. That again is still doable here in Wichita. It's increasingly difficult in other markets, but there's still pockets of really good operators that have good channels that they've built out good pipelines with. So yeah, we don't see it as any riskier. Our book for the past 2.5 years has performed phenomenally. Again, knock on wood. I mean, let's just knock on wood for the whole call here that I don't have to do that every time. I also have a philosophical thought on this. 2 thoughts, actually. First off, in Kansas, I guess more of a mathematical thing. In Kansas, 7.5 to 5% or 10% down payment really means nothing in our $100,000 purchase scenario. It really doesn't. What are you really changing, right? That's within just a buyer's flex point of what they're willing to pay when you're taking it out and you're exiting the properties. It felt kind of dumb to request, hey, I need $5,000 to make this deal
Right.
work. What's the point? We're a multi-million-dollar fund. We can shoulder some of that burden for our client. Now, we of course charge a higher than, the 90% loan to cost loans fee that's out there, but not super high compared to them. I mean, our average is 3% in origination, 12% rate. You might see for the 90% stuff, what, 1 in 10, 1 in 11. You're in it for 6 months. I mean, it's, a point and a half, two
Right.
points. It's a hell of a lot better than 5 to 7% down at the best end, right? That's the sharp end of the market. Maybe it's 10, 15. So it seems a marginal trade-off, and our borrowers have been very happy to accept that trade-off. You pay a slightly higher fee for it, which is still market for 100% loan to cost loans. I mean, that's what's out there. And that's just the math that we've done in our head of why it works. Our delinquency is very, very low. And I think it's also a testament to not sucking the life out of our borrower up front. At the end of the day, if you're 100% loan to cost lender, you sell liquidity. I sell scalability, speed, all those efficiencies that you get from hard money. Why take $10,000, $15,000 out of a client's pocket just to close a deal that I'm supposed to be lending 100% of the money for when I could just give them everything they need and then have them see through a clean project and then they take it out of the proceeds? I mean, you're effectively factoring it into your proceeds. You're not paying for it until the end. I mean, the way we've set up the fund, we don't care if you charge 3 and 12 or 0 and 18 over 6 months. That's the same deal to us. So
Mhm.
we really meet clients wherever their appetite is. We have plenty of borrowers that pay us 0 point in origination and 18% annualized rate. It's so funny today to go back as we've been doing a lot. Like we actually have meaningful trends that we can pay attention to and learn from and read. And when we talk to investors, it's easy for Justin and I to come out and say like, yeah, well, we designed the comp structure at the fund in a way that allows us the flexibility of pricing. We did it on accident. There was no point, like there was no theory behind it. We was just like, well, this just how we think we should price it, and then it worked out. And it's how we go about it. So a lot of a lot of the choices that we made at the fund level, mildly arbitrary at the time, but we've been very, very lucky that they played into our hands and they worked well. And that it's all worked out, right? When we gave 100% loan to cost loans on day one, it wasn't a loss mitigation tool. Today it is,
Mhm.
like we just covered, but it wasn't a loss mitigation tool. Well, it's a lot easier for me to sell 100% loan to cost than 90% loan to cost. So let's sell
Mhm.
100% loan to cost. I was still thinking as an originator, as the broker in that case, right? I wasn't thinking
Right.
about the return of capital and how much safer it was for us to be at 100% or like what our book performance was going to be in 6 to 8 months. It was just, well, the client wants 100, let's give them 100. And then, And looking back, it looked like we knew what we were doing, but we didn't really. Like we got lucky that it worked out. And I think that's half a business and just saying yes to the
Right.
right things. It's kind of all gone in a meaningful way, and we've just done the next right thing, and it's worked out for us.
And I think it's great that you share that. I feel like so often in the entrepreneur space in general, we get people who are like, this was all planned. I had a genius plan. It's amazing. And the truth is that there's a good amount of luck. There's a good amount of just like, we tried something and there's a lot of strikeouts too, right? And it's good to share about all that.
Sure. I've never
No, go ahead.
understood, the difference between like, people will be heralded for pivoting. Some of the best pivots we were doing this and then we switched to this, or in the same vein, depending on what that story was, it was, these guys pushed through and they just never gave up. Well, sometimes it's dumb to keep pushing through and you should have pivoted, right? And sometimes like, well, you shouldn't have pivoted. You could have just stayed there and you would have came up with this idea. I mean, who knows, right? You made the right decision at that time and it panned out. We started the fund because, these bigger East Coast lenders, we were getting big timed and they were blowing closings for us because we had small deals proportionally. Frankly, when we started, we were pissed off. We didn't have anybody that would work with us. So instead of letting somebody figure out how to work with us, we just decided to work for ourselves. And that worked out well. But we could have also been dumb and that we should have persisted with those guys, built better relationships, grown on their client list and gotten to this point where, they wanted to do business with us and they prioritized us. We pivoted. 3 years later, we looked smart for pivoting. I don't know. I can tell you 6 weeks into it, I felt pretty dumb. It wasn't going to work, but we kept just pushing through and it worked out. So we didn't really have any choice to other than push through. But yeah, I mean, like it's all revisionist and backward looking. It is what it is, but I'm glad it worked out the way it did.
Let's talk about that capital raising that you did pivot to, because we can speak about it from like a lending perspective, and yet whatever investing strategy somebody's doing, they often want to raise other people's money, right? Like OPM
Yeah.
is, I think, one of like the top acronyms now in real estate investing. So what did it look like for you to start this fund? And not every listener is a lender, so it sounds like you were brokering for other lenders, and then you raised this fund. Kind of walk through what that looked like and how it worked for you guys.
Well, yeah, yeah. So for us, coming from brokering, we didn't know how lending worked, if that makes sense. Like we knew how to get loans done, but we didn't know how to create the loans, how to service the loans, how to do any of those things. That was all new to us. If you're going to lend, you need money to lend out, right? Justin and I together, we had done well as brokers, but certainly not at this time, I mean, rates were 7% in the residential world, right? The business was not hot. We were doing our best, but it just wasn't enough. That's why we're kind of pivoting to the business lending side anyways. And so for us, like the only way for us to have enough capital to lend out was to raise a fund. And so, well, fund level legal type stuff. And how do we start a fund and how does that all look? And so that's where we got hooked up with Jurasi, now Fortra, which are big SEC lawyers, and
Hmm.
they're the leading name in all the private lending space from a legal perspective, and they're fantastic. And we really owe a lot of our success to some of the guidance that we got from that group and Kevin Kim specifically. But beyond that, we started raising money off of pro forma, and honestly, until maybe 6 months ago, when somebody said it, potential investor said it about another deal kind of adjacently, said, I've never seen a pro forma that didn't make money. And it actually made me stop and go like, I guess they all do, huh? Like, I mean, in theory, they do. Like, it never occurred to me that like everybody believes their pro forma makes money. To me, it was like the pro forma is a test to see if it works, if you can model it, make it work or not. And some pro formas don't make money and some pro formas do. We were starting to raise, we were raising off the pro forma of what we were going to do that's the only thing we had.
And what was the amount? Like, what was your goal amount that you raised in this fund?
So when we started, we had a participation partner, which was a bigger lender that we had brokered to. We were going to be 90-10 in terms of the capital stack. They'd give us 90% LTC loan. We'd kick in the 10 on top of it. Our goal was to be a $5 million fund raising retail style funds. So people from their 401k, small $50,000 checks, whatnot. And slowly we would nickel and dime our way to be a $5 million fund. Our first week, back to when I was saying that this felt like a dumb idea and we should have never done this. Our first week, that lender called us and said, hey, we had a liquidity event. We are not going to be able to fund any of these deals for you. You got to figure it out. Justin and I had $1 million in the pipeline loaded up, set to close that week. And we had the $100,000 we needed to be able to, friends and family dollars to be able to kick in and fund those, not the additional 900,000. And so
Wow.
for a week, we scrambled. I was going through my phone, calling this person. Hey, this is what I'm doing. First, and you have to explain, like, hey, this is what I'm doing now. This is how we're doing it, yada, yada, yada. Well, it sounds good. I said, "Hey, now I'd like you not only if you like that, good. I need $1 million. Can you
And
give
I
a
need it
million
this
dollars?"
week.
And then, like, you'd get, like, some of them would be like, "Yeah, okay, yeah, that kinda makes sense, like, let me see the math, let's see, I think it could work out, blah, blah, blah." When you need to buy it, I was like, "Well, yeah, Friday'd be cool." I'd take anything before Friday, but Friday's my kinda my deadline. It was always they just laugh at you, right?
Yeah.
But luckily, we didn't miss any of those closings. We found all the money. And it's kind of a testament to Wichita in general and the network we had and, doing good business prior and having a little bit of a name, certainly not in the private lending space or the fund management space or anything like that. I mean, God sakes, we're at the time where I think Justin and I are 26 and 27. Today we're 29 to 30 until June, and we'll be 30, 31. So I'm going to hold on to that 29 to 30 as long as I can. So with 3, 4 years ago, whatever that math works out to, neck tattoos, Justin's as tattooed as I am. I mean, we don't look like fund managers. Like, why would you give these two yahoos, $1 million? I mean, collectively, we were the same age as a lot of the investors that we were talking to individually. And so it was difficult. One of the best things we ever did was we pivoted how we were raising the capital. Instead of the fund, super high level, the way we set the fund up, every dollar of revenue that comes in, aside from a small admin fee, gets split 50-50 between the GPs and the LPs. Period, end of story. That's why it doesn't matter if I charge origination fee or rate, because they're getting a piece of the action either way. That's very different than other fund structures, generally speaking. Typically, the manager keeps the origination fee rather, and the interest is split between the LPs and GPs.
If you're a real estate entrepreneur trying to scale while doing everything yourself, there's a better way. The Time and Freedom Starter Pack gives you the exact first steps to reclaim hours each week with real support, including what to hand off, where to start, and simple tools you can put into place right away. Download it for free at adriennegreen.com/starter pack. Now let's get back to the episode.
That's not how we were setting it up. We did that so that it could boost the returns, or the returns go up because we're sharing in more of it, and we needed to be more generous to attract investment because we're rookies. And so it wasn't like now splitting that revenue and everything 50-50 is great because it aligns all the incentives. And that's been like a cornerstone of Dynamo Capital.
Mm-hmm.
But we got there by accident. That was just so we could sell the investment easier to have a higher return. And so our pro forma showed like 24% net to the investor.
Wow.
And yeah, your face kind of said it all, right? Everybody was like, yeah, that's stupid. That's not real. Like immediately they assume there's a lot of high risk associated with it and, blah, blah, blah. And we don't have a track record to back it up. We just have like kind of a gut feeling that it's going to work. And so what we did decide instead was like, okay, fine. We'll take debt at the manager and then bet on ourselves. Because if we're 50-50, our top line is 48% according to the pro forma. If I give you 12% fixed in return, investment into the manager, and we invest it from there, in theory, we should be taking home 3/4 of the return. We're betting ourselves and we're kind of doubling down. That worked. It worked out for the interim that we did it. And it was a good way for us to jumpstart the fund because we ultimately couldn't raise any money otherwise. You're asking investors who were very seasoned to invest in a variable rate return from a couple of rookie managers who have never done this before. I wouldn't have given myself the money either. I had a compelling story. Justin and I had a compelling story, but it wasn't necessarily investable. But they did like the fixed return. So we agreed to 1% a month. We kicked that out. And it's kind of history from there. And so that's how we started raising. For like our first full year, we did 30 net to the investor. That was a disgusting capital utilization rate that we were at. Certainly, I did not have this kind of gray beard before. It was very stressful for us. We were spending money as soon as it came in, but we had a lot of demand, and it was kind of good, proof of concept. In 25, we took a much more measured approach to how we would go about it, tried to smooth out the return for the investors. I mean, in 2024, we had some months that were 7% net back to the investor that month, and then, half a point the next month. It's because we spent all the money in one month, and then we didn't have any for the next month, right? It's just boop, 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 and we wanted to smooth that out in 25. So we did that. In 25, we finished just north of 21% net to the investor on the 50-50 split. So, I mean, we're doing 42 top line, which is, phenomenal. We're very happy with that. We've had to grow the fund tremendously, both in terms of capital raise that we've got. So we're north of a $115 million fund today, and right around $65 million in checks cashed in equity in the fund. And then the rest is lines of credit and facilities on top of that we manage. But one big thing for us is that we don't charge an AUM fee. We don't charge an assets under management fee. Justin and I certainly could. It would change the split, obviously, but, we don't see a reason that just because we carry a line of credit that we get paid for it. And again, that goes back to the alignment of incentives thing. So it just really speaks to our philosophy. It's made raising capital easier and easier because we've had proven track record now of it working. We've had a lot of people convert that debt into the LP position because it's performing better than the debt, obviously. And, I think our investors, first and foremost, like that we were betting on ourselves and that we were taking the risk. I mean, still to this day, Justin and I personally guarantee every dollar that's in the fund and every loan that's in the fund. So we put our money where our mouth is. Our whole team operates like it's their. We have 35 or 36 employees today, depending on start dates, and we're continuing to grow. And every one of them operates like this fund is theirs. Because ultimately it is, if the fund is here and it's performing well, then they continue to have jobs and they really do operate in a way that we feel just incredibly comfortable with everybody, being a face of the organization because they are in their particular fields, whether it's processing, servicing, underwriting, they interact with borrowers and investors and clients and, they ultimately represent Dynamo at every level. It's not just me and Justin that are in front of everything. I do a few of these podcasts here and there, but it's not like I'm talking to every client. They
Uh-huh.
really are the representation of this company, and they've all been very much in the image of what we wanted Dynamo to be and even beyond what we could have came up with.
I love that. It's definitely the mix of like the math and the people, right? It's all that together. Now, one other thing I think would be helpful for the listeners is, you had that initial fundraise, and something you've alluded to is how you are effectively leveraging with things like lines of capital and other things like that in the same way that, an investor who's used to buying doors and, doing single family rentals or something like that, they're leveraging with that mortgage. Can you speak about what that looks like on a private lending standpoint?
It's really no different, to be honest. I mean, high level, and this is you'll see the extent of my knowledge versus what Justin does for us. I do the talking, he does the thinking. So the easiest way that I can explain it, if you utilize a line of credit or a facility, or then there's a bunch of different kinds of facilities, but let's just broadly call them lines of credit. I'm sure Justin will cringe about how I call it a line of credit. If you're using a facility, you can fund $1 of loan for a fraction of that dollar, generally speaking. So as we've matured and gotten a better track record, we've gotten better facilities. In the past, we were able to fund a dollar of loan for 33 cents. Today we're able to fund it for 25 cents. As we get better and better and bigger and command more advance rate, then you can fund it for less. And so that allows us, I can raise $1 of investment and I can do $4 of loans for it, which obviously leverages the fund in a way, or levers the fund in a way that we're able to outpunch the equity that we've raised, and that's what pumps up the return. There's a number of other ways that we get to the return that we do. Leverage is obviously a big deal. And in the past, if I want to do $100,000 loan, I have to go out and raise $100,000. Today, if I want to do $100,000 loan, I have to have $25,000. So for
That's
the same
powerful.
$100,000, I can charge 4x origination fees and interest, doing 4x the amount of loan volume over the previous scenarios. 100% equity was a good way for us to start because it taught us like temperance and patience, and it kind of tried to. We were certainly overexerting, but now, I mean, I think a lot of other companies are slaves to their lines. I mean, hey, if we can't lever it, we won't do it because it's not efficient or whatever. Us starting at 100% equity in all these deals, that's what our expectation is. We're prepared to fund everything with our balance sheet, even if we can't lever it. We'll still fund it. We don't make decisions based on the efficiencies of our leverage. Therefore, we're not subject to the same box that everybody else is, because those lines of credit wants to see a certain look of loan, right? And if I have a line of credit with a certain provider, odds are they have a line of credit with another lender too, and our boxes are going to look similar. So us funding stuff that doesn't just fit on that and being willing to hold on our balance sheet gives us such a competitive advantage because we're willing to do common sense things, because we have really good partners and we try to build those boxes with the most common sense we can. But sometimes we depart on what we feel is common sense. And so there's metrics that they want to see. By example, our short-term stuff, we really don't have a minimum credit score, which is usually,
Mhm.
very common thing for everybody to have as a minimum credit score. I would ask you or any of your listeners to tell me what the difference between a 620 credit score and a 623 credit score is, right? And I would submit for you that their answer is as arbitrary as the FICO grading scale as it is.
Right.
There's no good reason behind it. There's so much context behind these. Is it a 650 that's coming up from 400? Is it a 650 that's coming down from 800? Traditional
Right.
lending looks at the 650 equally. We're looking at common sense. This client has built up from a 400. They had a bad deal that went sideways and things went up, and then they're trending upwards versus this is a fall from grace for somebody else. We might not want to
Right.
do that deal. But just because it says
Right.
650 in a snapshot, we price some certain way, that ain't stupid. And that's not how we price, not how we operate. We have a general contrarian belief that a lot of what's the difference between a $100,000 loan versus a $95,000 loan? $100,000 loan minimum for a lot of places, right?
Mhm.
Well, it's because what they're doing on the back end. Their facility won't take less than 100. Their securitization bucket won't go less than 100. It's stupid. Tell me the difference between 95 and $100,000. I know it's $5,000, but there's no value difference between the property there and the property there. It
Right.
doesn't make any sense, but it's because of the facilities and the box that they've put themselves in, that
Right.
everything has to fit in that box. We will continue to win on everything that fits outside that box. And especially as things continue to tighten up and more investors show up in the market and more institutional capital comes in, the box is going to continue to tighten, right? And
Mhm.
so when minimum credit scores creep up from 680 to 700, we see those 695 credit score clients come to us.
Right.
They're a perfectly viable
Right.
client for us. As it creeps up over 700, if you told me for the rest of our lending career we only did 715 credit score borrowers, I'd be over the moon. Over the moon. Great clients. Somewhere along the way, that's less than 720, which a bunch of people in a boardroom decided was acceptable.
Right.
And it's no longer acceptable for them to lend to the 715 borrower. They're not good enough for the money. It's ridiculous. So we will continue to lend to those borrowers with a smile on our face while everybody gets too wrapped up in the technicals but doesn't understand the actual deal itself. That's my
Right.
soapbox. I got a little passionate there, but that's why we're us. That's 100% us.
Right. And that's the difference when you are a lender who's come from being in the investing space otherwise, rather than just coming from a purely financial background, is you understand like the difference that this makes to those investors who are flipping, who are doing the burrs, and how, by doing this lending, again, I'll join you on the soapbox, right? We're creating like better houses for the community, safer, nicer houses for people to live in. We're allowing these investors to often make the most money they've ever made in their lives by doing these flips and this value add. And you're having your investors on the back end who are able to invest in something that isn't, Amazon stock, something that they can believe in,
Yeah.
something that is changing lives? So
Yeah, yeah. I
I'm
mean,
with you on
I
it.
think that's well said. I mean, my favorite. I mean, I think it's a good place to put a bow on it. My favorite story in the fund, my favorite archetype of client in the fund, is a GC who has built homes for investors for years, and has made everybody else all the money. And they take their fee, and of course, they make their money there. But like, they don't take home the equity. They don't have anything to show for it other than the cash at the end of the day.
Mhm.
In the traditional lending sense, those guys are considered first-time borrowers, first-time investors, even though they've built 100 houses prior. They've never been on the HUD. They don't have any technical experience. Legally, they've never transacted, right? They've always been the builder. I 100% assert for you that they are better operators and they are better investors than the borrowers who built the homes with the help of that GC. That investor doesn't know how to build that house. The GC knows how
Right.
to build that house. We will lend to that GC every day. They are not a rookie borrower that is unlendable or won't get the best terms. I give those guys the best terms because they know what they're doing. We can help them understand how to structure a loan and manage the project from a capital perspective, from a lending perspective, because that's the piece they don't do. That piece is easy. Swinging the hammer, putting up the trusses, hanging the siding, hanging the wind, all that's the hard part of this. We will invest in those guys every day. Traditional lending won't. They
Right.
get hit with a first time experience leverage hit or higher pricing or whatever. Those guys, we dump as much resource into them as possible because they actually do know what they're doing and the context matters. But just because arbitrarily they're not on the bottom of a fancy piece of paper that says settlement statement at the top, they don't get the credit. It's ridiculous.
Right. Yeah, you wanna bring some common sense into the lending world. I appreciate that.
We're trying. I
Now
don't know if it's what we're doing. I don't know if it's working. I don't know if it's common sense. It certainly doesn't feel common at this point, but we're doing something. That's what I can tell you.
now, Matt, if people would like to reach out and learn more, or they're in Kansas and would be interested in borrowing, what is the best way for them to reach out?
Yep. So dynamocapital.com, you can submit a loan inquiry or anything there. You can submit an investment inquiry as well. We're not just focused on Wichita and Kansas. That's where our bread and butter is. It's always going to be home for us. Anywhere in the Midwest we want to lend in. We do have a national presence from a brokering perspective. And we're happy to look at anything. We've got loans all across the country where we're licensed. No California today. It's on the roadmap. But yeah, no, I mean, we'll look at anything. Generally speaking, we really like the Midwest, obviously, because I know it the best. But happy to look at anything with a good, strong operator. that we can have a connection to and build a relationship with, that's where we want to focus. We don't want to lend to every Tom, Dick, and Harry. We want to lend to high level operators that we can really be partners with. And, that's the main focus. So yeah, dynamocapital.com, submit an inquiry, submit a lead there, and we're happy to do it. You can also email me at matthew@dynamocapital.com. Happy to chat and go from there. So any level of interest, whether on the property side, the investment side, you want to know where I got my hat, I don't care, right? I'm happy to talk about any of this stuff.
I love it. Thank you so much, Matt. And for our listeners, thanks for joining me for another episode of the Freedom Blueprint. Be sure to join me again next week with another awesome guest, and I'll see you then.